Welcome back to the channel. Today, we're diving into yet another economic mess that no one wants to talk about but we need to talk about, the Federal Reserve's Main Street Lending Program, MSLP. This program, designed during the height of the COVID-19 crisis to rescue struggling mid-sized organizations, has instead left many businesses gasping for air under the weight of skyrocketing interest rates and crushing balloon payments. How did this happen? Why was it allowed to happen? And what does this say about America's economic management, or lack thereof? Let's break it down. The MSLP was supposed to be a lifeline. Back in 2020, as the pandemic unleashed chaos on American businesses, Congress approved the largest stimulus package in U.S. history, the $2.2 trillion CARES Act. But, while programs like the Paycheck Protection Program, PPP, offered forgivable loans to small businesses, mid-sized firms, the so-called backbone of the American economy, found themselves too big to qualify for PPP loans and too small to take advantage of public capital markets. The Main Street Lending Program was born to fill that gap. On paper, it sounds almost heroic, 1,830 adjustable rate loans, ranging from $100,000 to $300 million, extended to mid-sized companies struggling to survive in a landscape battered by lockdowns and disrupted supply chains. The Fed even assumed most of the credit risk, leaving banks on the hook for just 5% of the balance. But fast forward to 2024, and here we are, many of these loans are now landmines triggered by sky-high interest rates and imminent balloon payments. Businesses promised relief in 2020 are now watching that relief spiral into ruin. Let me explain the trap here. The loans were structured with initially generous terms, no interest or principal payments were due in the first year. But that breathing room has since turned into a chokehold. Many loans came with adjustable rates, and as inflation surged and the Fed raised interest rates aggressively to combat it, those adjustable rates adjusted sharply upward. Businesses that were barely making ends meet now face interest payments that have tripled or even quadrupled, on top of lump sum principal payments due next year. Add to this cocktail of disaster the brutal economic environment of the post-pandemic era, inflation, a tight labor market, lingering supply chain disruptions, and a sluggish return to normal consumer behavior. Instead of saving businesses, the MSLP has exacerbated their financial strain, forcing many into layoffs, bankruptcy, and even fraud investigations. The core of this issue lies in the Fed's decision to peg these loans to adjustable interest rates. During the early days of the pandemic, interest rates were at historically low levels, making the loans relatively affordable. Businesses took loans with the expectation of normalizing, stabilizing economic conditions. But no one accounted for what came next, the steepest series of Fed rate hikes in modern history. In 2022 and 2023, in response to inflation breaking records not seen since the 1970s and 80s, the Federal Reserve raised interest rates 11 times, pushing the federal funds rate to between 5.25% and 5.5% by mid-2023. Compare this to near zero rates in 2020, and you get a devastating mismatch. Businesses like Atypical Digital were paying $11,000 a month in interest in 2021, manageable, with some belt tightening. That same payment has now ballooned to $25,000 per month or more. These businesses are essentially drowning in debt they never thought could become so expensive. The Fed encouraged businesses receiving MSLP loans to retain employees, but that was wishful thinking at best. With ballooning monthly payments, businesses are slashing their workforce just to stay afloat. Atypical Digital has laid off 60% of its staff, scrambling to make its payments. These layoffs ripple through the economy, creating another layer of instability for households and local economies desperately trying to recover. Instead of fueling job retention and growth, MSLP has turned into a job destruction machine, locking businesses into a vicious cycle. They cut jobs to pay their loans, but then see revenues decline, making the loans even less manageable. As of October 31, 2023, a staggering $1.23 billion in loans under the MSLP program was already in default. But that's just the beginning. Experts, including government watchdog groups, are warning of a tsunami of defaults ahead, as the clock ticks down on balloon payments due in 2024. Many of these businesses, particularly in the service sector, think small cruise lines, gyms, and entertainment venues, hinged their survival on a return to pre-pandemic normalcy that never quite materialized. Take World of Beer's sad spiral into Chapter 11 bankruptcy. The restaurant and bar chain used part of its $8 million loan to open new locations during what they assumed would be a thriving post-pandemic economy. Instead, inflation drove up supply costs, interest payments absorbed any potential profits, and the slow return to office work decimated their expected regular customer base. Now their locations are shuttered, their employees are jobless, and their debt remains unpaid. As if the defaults weren't enough, the MSLP has also become a breeding ground for fraud. Over 70% of investigations into the program now involve defaults, according to the Special Inspector General for Pandemic Recovery. From a woman in Oklahoma using her loan to build a house to companies exaggerating payrolls to game the system, MSLP reveals how haphazard government oversight during the pandemic led to rampant abuse. The failures of the Main Street lending program underscore some glaring lessons about America's economic approach. 1. Short-term thinking creates long-term crises. The MSLP was a reactionary measure, thrown together at breakneck speed in 2020. Policymakers were understandably racing to contain a massive economic meltdown, but they failed to foresee how future economic trends, like inflation and rising interest rates, could undermine the program. Was the Fed too focused on stability in the immediate term while ignoring the looming pain of eventual repayment terms? Clearly, yes. 2. Post-pandemic America is no one's America. The MSLP's assumptions about a bounce-back economy now look laughably naive. Businesses like World of Beer banked on bustling offices, thriving urban centers, and consumers eager to spend. Instead, hybrid work persisted, discretionary spending tightened under inflationary pressures, and urban centers struggled with lagging recovery. The Fed and Congress based their policy skeletons on a vision of America that didn't survive the pandemic. 3. The Fed is playing with fire. The Fed's reliance on adjustable rate loans reflects its broader consensus: inflation targeting comes first. But in doing so, it has once again placed corporations and Main Street America in harm's way. Combine this with tightening credit conditions and a potential recession, and you see how policies affecting business lending are positioning mid-sized firms for a painful reckoning. 4. Government rescue efforts often hurt the very people they aim to save. The MSLP was touted as a safety net for mid-sized businesses, yet, due to flawed design and stringent repayment structures, it has become an albatross around their necks. Where PPP offered forgiveness, and large corporations got access to the Fed's near-limitless liquidity, mid-sized firms were forced to shoulder all the risk, with little flexibility to adapt to an evolving economic nightmare. So where does all this leave us? The MSLP saga is far more than just a story of troubled loans. It's a symbol of government overconfidence meeting economic uncertainty. And as these loans come due, the fallout will only spotlight the inequities of an economic system that too often crushes the little guy while protecting the big fish. For the businesses stuck in this vicious cycle, there's no easy way out. For the Fed, it's time to rethink how programs like MSLP are designed, and whether they truly address the needs of American businesses. Otherwise, we're not just looking at defaults on loans, we're looking at a default on faith in the American economic system. As always, thank you for tuning in. Leave your thoughts in the comments below. How do you feel about the Fed's handling of this mess? And don't forget to like, share, and subscribe so we can keep shining a light on these economic blunders. Until next time, stay sharp and stay skeptical.